This is another Repo Madness 2021 update. So this week we found out that the large banks like Credit Suisse and others were drastically reducing the lines of credit, margin debt, other types of credit that these hedge funds and family offices can borrow with to leverage up trades. But it is probably already too late, that a lot of these banks are going to have enormous losses. The Fed is going to have to buy a lot of this toxic garbage at some point. They probably won't even put it on their balance sheet because now they can legally get away with as many special purpose vehicles off balance sheet, onshore and offshore probably, as they want. As the US Treasury changed the rules back in March of 2020 to allow the Fed to create special purpose vehicles that are very similar to how organized crime makes shell companies both onshore and offshore. So these stories are saying that Credit Suisse is reducing the credit lines for hedge funds and family offices by a third. But we had pretty much every month for the last couple months, stock margin debt hit all-time highs month after month after month. Back in March, we had another new all-time high. February was very similar. The chart of margin debt on US stocks, which is how a lot of these hedge funds and family offices trade. They borrow extra money to leverage up trades on some of these market mover stocks and derivatives and bonds. A lot of crazy trades, especially with leverage. A lot of these banks are going to have losses unless the Fed comes in and bails them out secretly. Also, the Wall Street Journal has put out a number of articles over the last 6 weeks talking about how Japanese pension funds were some of the main sellers of US Treasuries, and that helped accelerate problems in the repo market by how many treasuries were dumped by Japanese banks and Japanese pension funds. I'll attach some articles about this below the video in the information and description section. Finally, I found this story about a month ago. I was saving it to combine with other Repo Madness 2021 update news. It was a speech that was covered in a Reuters article on Thursday, April 15th by Laurie Logan, an executive vice president at the New York Fed and the manager of the System Open Market account. If you're not familiar with her, she was the person back in 2019 who was in charge of the Fed's overnight repo program, overnight repo facility. So she was the one who was giving the updates about all the repo problems that started in August, September, and October of 2019. So she's been in charge of the repo program, the Fed's repo program, because there's private repo markets too, for the last 20 or so months. Supposedly in the speech, and it was covered in this Reuters article, there's some really weird comments, and I have a couple theories on it. Now, she said that the central bank could expand access to the overnight repo facility by relaxing some of the eligibility requirements. Fed officials agreed at the March policy setting meeting to increase the per counterparty limit to $80 billion from $30 billion. So that's a big increase in borrowing from the Fed's repo facility. But also, she said in the speech that the central bank could expand access to the overnight repo facility by relaxing some of the eligibility requirements. Now, I have a couple theories on this, and it's going to be tough to prove them, but the Fed has done them in the past during the last repo crisis. The Fed's balance sheet expanded officially by about $1 trillion within a couple months, from around $3 trillion up to $4 trillion as the repo crisis unfolded. Now, with the special purpose vehicles that are legally allowed, that are legalized, that might not happen. But what I suspect might be happening now is the Fed, by relaxing some of the eligibility requirements, using their words and from the article what was quoted, relaxing some of the eligibility requirements, they could theoretically allow hedge funds and family offices to post collateral, and then they can borrow directly from the Fed's overnight repo facility. So that's one possibility. The other possibility is that there's so much toxic garbage, and this is not good collateral. So this is not the normal US Treasuries that are considered good collateral for getting loans, for getting large loans, many billions of dollars in loans. Normally, to borrow in the Eurodollar market or the repo markets, the private repo market or the Fed's repo facility, you have to post good collateral. At least that's what they say on the surface. However, the rules got fast and loose in 2019, and the Fed was starting to allow all types of collateral to be posted. So I suspect what could be happening also, the other scenario with the wording here from this speech about a month ago, is that the Fed is now allowing almost any type of collateral, almost any type of toxic sausage, really garbage stuff. So commercial real estate mortgage-backed securities, regular mortgage-backed securities, residential ones, all different types of toxic sausage derivatives that might be worth nowhere near 100 cents on the dollar what these hedge funds and family offices paid for with leveraged trades. And these assets, and I'm using air quotes here, are probably worth maybe 10, 20 cents on the dollar. And the Fed's going to give these hedge funds and family offices or banks that are holding this collateral 100 cents on the dollar value equivalent as basically a hidden backdoor bailout. So this could be a scenario. I don't know if we're ever going to find out the truth, if the Fed is doing this or not. They'll tell us if they want us to know in public to keep people confident that they're flushing the hedge funds and the family offices and banks like Credit Suisse and others that are in this mess now, flushing them with more cash and more liquidity to help them. They will let us know in public. But I suspect that this is already happening, at least to a certain extent. We may never know exactly how much, because the repo crisis in 2019 was much, much larger than they wanted us to know. At one point, there was $1 trillion per day being tapped in the emergency overnight Fed borrowing facility back in 2019. So to wrap this up, I suspect that Repo Madness is getting worse. I think the rules are changing. The losses for the banks are going to continue to grow. We're probably going to get a lack of transparency here unless the Fed actually wants to tell us what's going on by saying that the stock markets are going to be fine. We're going to inject massive amounts of liquidity. We're going to pay 100 cents on the dollar for this toxic garbage stuff that the banks or hedge funds or family offices that are being allowed to borrow from the Fed's overnight repo facility are posting as collateral. Again, this goes back to stagflate tax lie, more rules changes, more currency creation. This is the Cantillon effect. The majority of this excess currency and credit creation is going to large corporations, governments, big governments that are too big to fail, large banks that are too big to fail, and now hedge funds and family offices that are also too big to fail. So I'll keep updating this as I see more stories, but as of now, these are the things that are most interesting regarding repo and the hedge funds and family offices and the large banks like Credit Suisse that are involved in all this. And the losses are probably going to end up much, much larger than Credit Suisse was claiming. Finally, if you enjoy content like this and want to help keep content like this free, please chip in $5 a month to my Patreon, where I have over 150 articles, charts, and audio podcasts on many different topics to learn and do research about investing in the economy, specific stocks, specific sectors. And just in the last 2 or so weeks, there's 4 new articles. A couple of them took me many hours of research. And please like the video and subscribe to the channel. Hopefully the channel will get to 50,000 YouTube channel subscribers quickly, and we'll get to 10 million views in the not too distant future.